because I feel like there's no room to over deliver if you're just like saying, oh yeah, we've got $1 trillion of capital in the room. Like it like sounds like hokey on some level and you kind of lose credibility. So I don't know. We try to be a little bit anti that, even though maybe we don't brag enough or do the whole Wolf of Wall Street chest beat.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome to the Capital Raising Show. I'm your host, Tim Mai, and today I have an amazing guest on the line with us. His specialty is in family office, so I'm super excited about that. Mr. Richard C. Wilson, third generation Eagle Scout. How cool is that? Not too many people can say that. Husband, father of three, living in Scottsdale, Arizona. He is the CEO and founder of the Family Office Club, which we've all heard great things about your club. The #1 largest association with over 3,000 registered ultra wealthy families and their family offices. Richard has helped create and formalize 150 plus family offices and counts a shark from Shark Tank, several billionaires, many REITs, and 700 plus investors with an average net worth of $28 million as clients. Richard works with clients through investorclub.com, Doctors Investor Club, where he helps them access top screen direct investments. Richard's 22-person team operates multiple media platforms, including Dentist Investors LLC, InvestorsResidences.com, Billionaires.com, and CommercialRealEstate.com. Richard has written 3 #1 bestseller family office books on single family offices, how to start a family office, and Centimillionaire Strategies, 100 million plus net worth families. Richard has an undergraduate degree in business, an MBA, and has studied postmaster's psychology through Harvard University's ALM division. Woohoo! Well, welcome, Richard.
Well, thanks, Tim. Appreciate you having me here, and sorry for such a long bio.
No problem. All right, super excited to have you here. Yeah, I'd love for you to start out and share with everybody how did your journey take you into this whole family office space?
Sure. Well, I grew up around my dad raising over $1 billion for hospitals and universities in the nonprofit space. So I went to meetings growing up and read Inc. magazine as a kid, and I started 4 or 5 businesses before I was even out of high school. When I got out of college, got into risk consulting, got paid a lot of money. I paid for my MBA, but then got bored doing that. So I started raising capital for hedge funds as a placement agent. And while doing that, I realized that to invest in most hedge funds, you have to be an accredited investor. So I figured, who has all the accredited investors? Well, wealth management firms do, who serve the ultra wealthy. And they were just starting to be called family offices back in 2006, 2007, when I started raising capital. And so I realized, I should only be calling on family offices. And when I tried to do that, it was super hard. There were no trail guides. There were no people providing coaching. There were really almost no books on the space either. So we just started reading everything we could on the space, meeting with every family office I could. And then everything kind of snowballed from there. And our blog, that was a free to access blog at the time, started getting 1,000, 3,000, 5,000 hits a day, wrote a book for Wiley. And now 15 years later, after speaking at a couple hundred events, we've hosted 185 of our own events now.
Wow. That's amazing. Yeah, and you guys host an event, at least one a month. Right?
Yeah, for sure. And you know probably who Joe Polish and Dean Jackson and Gary Hubbard and Jay Abraham and Dan Kennedy and Dan Sullivan. And I just got off a Zoom call with Evan Pagan yesterday, who was one of my first mentors. Those people teach a whole bunch of stuff, and I just applied it to the family office niche for 15 years. And then the byproduct are these other skill sets that we have now in structuring deals or having a big Rolodex, et cetera.
That's awesome. Yeah, I've been in the info marketing space now for a good 16, 17 years. So cool. I do know a lot of the names you mentioned. I don't think, so that's pretty cool. Awesome. So share with us what's unique, what's different about raising money from family offices versus retail investors.
Sure. One thing that's unique is that if you're raising $1,000 at a time, then you could just have a splash page on a crowdfunding website and maybe you'll get some people to put in $1,000, right? If you're used to raising $50,000 and $100,000 checks, you might be dealing with investors that only see a few deals a year. You might be going to friends and family and getting the money you need for your first couple of deals. When you go to family offices, you're usually dealing with people that see a lot of deals per year. They're more sophisticated, they're more picky, they've got better deal flow. So to even get their attention, your deal has to be much better than average. But one of our members of our investor club, she credited us publicly recently in an article where she didn't know what a family office was, came to one of our events, joined the club, and she raised an $8 million check and a $40 million check. But she took 18 months to do that. Wasn't easy, took a lot of follow-up, but a $40 million check replaces 400 $100,000 checks. So, it's 400 times more valuable to get that check than a 100K check. But people should know, obviously, someone putting $40 million into something as your only investor has way more leverage than somebody putting in $10,000 and they're one of 1,000 investors. They're going to get different terms, of course. But as long as the terms are, even if they're only half as good for you, it's still 20 times more effective than going after, 200 investors. So that's the major difference, I would say. They're more sophisticated, more picky, harder to access. They don't owe you a response to your emails. So if you don't be very thoughtful in approaching them, then you shouldn't really expect a reply because they get hundreds and hundreds of emails all the time.
Gotcha. Okay, so let's talk about that. So what are some of your tips in how to approach a family office?
Sure. Well, the best thing you can possibly do is have them approach you, right? So it's more compelling when someone has a migraine to reach out and you look like the Excedrin for their migraine rather than you knock on their door and try to sell them something, whether or not they want it at that moment in time. So when you're thinking about how to position yourself in the market, you want to do so in such a unique way that just by hearing your brand name and your one-liner, they lean forward. Most people have brand names like Wilson Capital, and then people have no idea what you do. It could be a biotech company, it could be buying storage facilities. Most people do not even have a one-liner, which means one sentence that in a really compelling fashion says exactly what you do. A lot of people say, oh, we're lower middle market private equity, or we're value add workforce housing multifamily. Well, so are 10,000 other people in your industry. So what makes you unique compared to all of the other ones, right? Are you performance fee only? Do you only get paid after X? Are your hurdles different? Do you turn around the property and buy, sell within 12 months or less? So your IRRs are really nice. What makes you super unique? And that's really important. If you can't name 2 or 3 things that make you really unique, then you're only going to raise capital from people who don't see very much deal flow. And maybe you could excel at that and build a funnel that just sucks in people who never get to see deals and you get to raise a ton of capital. But if you want to raise family office capital, you have to be compelling and unique compared to the hundreds of people who have traction in the space already.
Gotcha. So how do you even begin to find these family offices?
Well, one way that I'm biased as is we host a 1,000 person conference every quarter. So every 3 months we're hosting a 1,000 person event, and we have 50 to 70 speakers on stage, up to 150 speakers on stage at one event. So in December, our Family Office Super Summit has 1,700 people there and 150 speakers on stage. So we will flood your brain with family office ideas, structures, best practices, investor mandates. And if you just sit back and just listen and just suck it all in like a sponge the whole time, and you don't talk to a single human being, you'll get a sense for the pulse of the industry, because it's just like listening to 150 TED Talks, basically, because we have discussion panels and standalone talks. Obviously, we're not the only people that exist on planet Earth in the industry. You can go to other people's events. You could read books on the industry and understand how they think, and then figure out how to identify them in your local community. You can also see who owns the biggest assets in your town. When I moved here to Scottsdale recently, I saw a chain of service companies that had a subscription model. And I thought, oh, that's a really cool model. I looked on their website while I was still in their parking lot. I saw they had 16 locations, and I saw there was 2 owners. I reached out to the 2 owners on LinkedIn cold with a 2-sentence message. They both replied to me the same day. I met with them. I learned that they had just sold their business to Goldman Sachs for $130 million. And now they're starting another platform in Texas that was similar. So we met an ultra wealthy family the first week we were in town, just by reaching out, offering them something of value. So when you identify someone who obviously is the chairman or CEO or head of a publicly traded company, or billionaire or someone who's just worth 10, $20 million, figure out what's in it for them and make it irresistible to reply to you, because you're going to help them get a client. Or in this case, I was helping them not get diluted every time they open a new service station, and designed an investment structure for them that was superior to what they were using at that time. So that's really the best way, is to add value first and reach out proactively, but then put yourself in communities where you're surrounded by family offices, right? Like live in a community, work in a place where they're at, be part of business ownership clubs that cost, $10, $15, $25,000 plus a year, so that only people can afford to go are business owners or people that are doing very well. Ideas like that help.
Gotcha. That's awesome. So, I know you mentioned about your event, 1,700. So like, give us a sort of a feel for how many, the type of people that go there. Our family offices, definitely, right? And so like, what's the percentage that are there that are family offices versus other investors? Give us a feel for that.
Yeah, sure. So we have multifamily offices who attend that are hard to convince to back you. But if you do, then they might have 20 or 50 or 200 wealthy clients that they could put your product, they could put money into your fund or your offerings. So those can be the biggest return if you can win them over. We have single family offices, which have their own dedicated teams and are usually their net worth are 50 to 100 million plus or much higher. We have then virtual family offices and private investors who may be worth 5, 10, 15, $20 million. And they may or may not have a fully formalized family office, or they might keep it very lean on purpose. And then we'll have some angel investors and people that invest into early stage companies there. And we'll have heads of angel investor clubs and heads of other investor clubs at our events as well. So one group that we work with closely is Left Field Investors, for example. They have 800 investors in their network, and the founder will be at our annual event on stage in December. So it's a chance to connect with other investor clubs, as well as a full array of different types of investors. But out of 1,700 people, it's probably 50% investors and 50% non-investors there in the room, but a full spectrum of types.
Gotcha. Very cool. So now you also raise money for your deals as well. With you having access to so much money, what are some of your challenges that you deal with when it comes to raising capital?
Yeah, sure. So we deal with the challenge of just never-ending stream of email problems, right? So just keeping on top of communications, color coding emails, snoozing them to certain days of the week, et cetera. That's one of the biggest challenges, to be perfectly honest, just email flow volume. And I think family offices in general deal with this challenge, which is why it's super critical to know exactly what makes you unique and communicate that really clearly with your brand and everything. The other challenge is just the amount of time it takes to develop a relationship with a billionaire or a $1 billion balance sheet partner. One of our clients is a billionaire that we have gotten 19 deals done with. We just closed a $20 million deal last Tuesday. We closed a $30 million deal with them about 2.5 months ago. And the first 6 years we knew him, we didn't get any deals done. And now we do many deals a year with him. With another group, we took 14 months to get our first deal done with a $4 billion REIT. And now we've closed our second deal with them. With another group, we've gotten to know them for 5 months so far, and we have a $50 million term sheet, but no deal closed with them yet. And then with some smaller investors, things go quickly and they hear about what we're doing. And then, they come in, right away, a week later or something. So to simplify our world though, we really only do 3 things related to capital raising. And as we learn lessons, we just share them with our investor club, because I don't think anybody here runs a family office club and has the same 3-part focus that we have. So the first part is that we invest into medical and dental clinics that are profitable, already existing, not startups, not AI technology, nothing VC, just medical and dental practices with multiple locations that are doing well. We then invest into our own, we have our own fund in the Airbnb space called investorresidences.com, and we acquire Airbnb properties that are value add, and we'll buy a big acreage property, add cabins to it, or turn a garage into a couple extra bedrooms and just look for value add Airbnb properties. That's the second area. And then the only other third area is really just listening to our big clients. If we have a $1 billion plus balance sheet partner, for example, one of them was launching a REIT. We sourced a portfolio of 16 hotels for them valued at $350 million. And they've signed the term sheet, they've signed the JV agreement. We're just waiting for the deal to close at this point, but we'll try to source one-off things for big partners. But those are usually kind of co-GP relationships, JV relationships, or a pot of assets. And we're just trying to be most helpful to these big balance sheet partners, even if it's not medical, dental, or Airbnb, because I think that just makes our investor club more powerful if we could ever have 10 or 20 of those partners versus the 4 to 5 we have that are highly active now. Then I think it would really transform our business. So sorry for the long answer, but that's where we're focused. Yeah.
No, that's really good. And then, so like for the people listening, if they have a deal on medical or something interesting with the Airbnb, are you looking for partners, or how what do you look for around that?
Yeah, sure. So anyone who has an existing medical or dental clinic asset, we're especially interested in dermatology and dental. But we're open to any type of medical clinics, including med spas, et cetera. If you have an existing asset, we might be able to invest with you or JV with you. If you're raising capital for a deal in that area, happy to looking at working together. If you have an existing Airbnb asset or a piece of acreage, like we talked last week with someone that owns 3,000 acres in their wife's family's trust. And some of it is like plantation type houses and land that could be developed. Then we can JV with families like that, and we don't have to buy the whole thing. We leave some upside for the family. Maybe we buy 80% or we buy 50%, and we develop it together as partners. So that would be one way to keep in touch with people here. And if anyone has someone who's starting a family office, or once has a client who has $1 billion plus on their balance sheet, whether they're publicly traded or a billionaire or a big group that's always looking for co-GP JV partners, we really add a ton of value to those groups, because we have $4 million a year in overhead running all of our conferences and running all of our websites and our 22-person team. And even a billionaire usually doesn't like to spend more than $4 million a year running their family office. And our business is being ran to get maximum exposure, because we own capitalraising.com and billionaires.com and commercialrealestate.com. So we have as good or better deal flow than probably 70% of billionaires out there. I'm sure Mark Cuban has way better deal flow than me. But in general, we can compete with them quite nicely on the quality of deals we can source. That's
awesome. So is deal flow one of the like bigger challenges that they deal with?
Yeah, I think it is. But the trick is it has to be really, really unique, super compelling deal flow. A lot of people come to me and they say, "Oh man, if I had more capital, we could do $2 billion of deals this year." It's like, yeah, so could anybody who has access to LoopNet, right? There's no shortage of deals, right? So it's the shortage of a deal which is super compelling and exciting, and compared to all the other deals, it's head and shoulders better than the other deals. That's what's really critical. And so the families don't want just more deal flow. They want more deal flow that's so much better than the other ones that if they didn't meet with the team in person and didn't understand how that value is created, they wouldn't even believe that the IRRs were that high, or they wouldn't even believe that maybe they could produce that type of return with that low of risk or something of that nature. So you have to have something that makes a really sophisticated person lean forward from the beginning. And so those are kind of 1 out of 500, or when we look at 500 strategies, maybe there's 1, 2, 3 that stand out of 500 that really make us lean forward. And those are the types that we bring to our clients.
That's awesome. And so what are some of, like, let's say someone's starting out and they want to head down this direction of specializing in doing business with family offices. What are the steps you would advise someone listening to go through?
Sure. One thing is to make sure you've studied your competition, and you've also decided what type of investor you want to focus on, not just family offices or wealthy investors, but if you're raising capital for a manufacturing private equity group, maybe you raise capital from manufacturing business owners and you find the inner circle group that costs $25,000 a year to join of manufacturing execs, and they could maybe apply one of your manufacturing tech devices inside their facility, test it out, and then invest money because they know it works. And then there's strategic capital, and you raise the capital faster. You don't have to teach them the ABCs of manufacturing. If you're raising capital for a litigation hedge fund, maybe you go to law firm partners and get a database of those and retarget them on Facebook and LinkedIn, and go to law firm conferences and speak on stage and figure out what 1,000 lawyers live near you. who do well, and then meet with them face to face and drip on them and create a funnel around that. So being really focused on the type of investor, and then also what family offices are nearby you, so you can meet with them over and over again, or nearby the asset you're buying. Maybe you're in San Diego, but you're buying self-storage in Austin. So you could target investors in San Diego and Austin, but maybe you used to be a doctor or a manufacturing executive. So you might also go to them. Even though it's a self-storage asset, you might speak the language of manufacturing executives and be able to convince them to put money in self-storage just like you did. So those are some of the first high-level things. A couple other things I took notes down on to make sure and share with you guys today is that all of our investors would really like to see a 2 to 4 minute video of you articulating their strategy, what makes you unique, and none of your competition wants to do this. We have about 1,000 members in the Family Office Club who are raising capital for something, about 3,000 investors in there as well. But out of the 1,000 people raising capital, maybe 1 or 2 have a video from their founder on their one pager, on their website, and their pitch deck, and nobody else bothers to have one. They spend all this time creating a 44-page pitch deck that's probably twice as long as it needs to be. But if they met you over coffee for 30 seconds and shook your hand, they would either probably be much more inclined or not inclined to work with you. You know, you learn a lot about someone just by talking to them just for 2 minutes about what they're doing. And you can have a pretty good feeling of whether you're going to follow up with that person or not. So make sure you've got a video, make sure you've got a one-liner, make sure what you're positioning is super unique. And you want to have a couple of really compelling points on why they should respond to you, instead of, you know, sometimes I start my day and I have 377 emails in my inbox that are not spam. So I can only physically write 50 to 100 emails in a day if I'm being highly productive and I'm not in an event that day. So who am I going to respond to out of 377? I have to go through and select the top clients, the ones that are either color coded or I know they're really important. So investors are doing the exact same thing. So you really have to make sure your positioning is really, really dialed in.
Gotcha. And so, you know, a lot of people on here are in the multifamily space, right? And like you mentioned earlier, everybody's name starts with something capital. How would someone that's in the multifamily space be able to stand out? What would you recommend them to do to stand out? You know,
Sure.
Especially in front of these family offices.
Sure, lots of things. First of all, we've had a group that had $7 billion in assets, over 300 investors in their group, and they rebranded to a better name because their name was just 3 letters and nobody knew what it meant. And they took the time to rebrand to something that actually attracted new clients. So I don't care if you have business cards printed, those cost $10. I don't care if you have a website, you can change out the logo really easy. It's not too late to change your brand because you probably don't manage $7 billion. No offense if you're on this webinar, because that means you're probably raising $100 million a month if you're at that level. And so it's not too late to change your brand. At one point, we went from Family Office Club to Wilson Conferences, and immediately we saw a drop off in interest, and we went back to Family Office Club. But some other ways to have a unique offering, if you're just in love with your brand that nobody knows what it means when they read it, I realize lots of people are in that position. Or your partner is just never going to change their mind. I know that happens quite a bit as well. There's other things you can do. A lot of multifamily firms are spread out all over the place. They're like, oh yeah, we'll invest anywhere in the United States or anywhere in the Eastern Seaboard, or we like these 5 states. And you're like a 6-person or 12-person team trying to cover 6 different states of the United States. I think some investors like a really niche focus. So like, we only buy multifamily in Kansas City, and we're the number 4 largest multifamily owner in Kansas City. And we know it like the back of our hand, and we only focus on these 3 zip codes. And on those 3 zip codes, we only focus on this size to this size because of ABC. And in that, we only focus on value adds where we can turn it over in 18 months or less, et cetera. That's a real laser focus. So you could know within those zip codes, the 392 assets that exist on planet Earth that meet that criteria. And then you could figure out who owns those, what lawyer is in the state corporation documents representing them, or is not as the managing member of that LLC. You could build a database of those asset owners. You could work that list. And then when they want to go to sell, you could say, you can show it to me first and I'll save you your brokerage fee. And we'll just do it for like a 1%, do the paperwork for me, or just do it through a real estate attorney and save the brokerage fee or something else. And so a super laser focus could be one unique aspect that you could bring to the table. The other could be dialing it in to one specific investor type, like law firm partners or manufacturing executives. And you just go super deep on building the best investor funnel in the United States for owners of manufacturing companies or law firm partners. that takes focused effort and good communication and understanding of that niche market. Most people don't want to do that. They say, oh, I don't want to turn away all the other investors, but you can still accept other investors into your funnel. If they come knocking, you still accept their capital and bring them in and meet with them, of course. You just get really, really good at one investor type. And you can go so far as even adapting your branding to that one investor type. So that you're the manufacturing executives investor club, or you're the Kansas City private investor club. And then you're really, putting people into your multifamily projects as well as whatever else you want to do. So super niche based on geography, super niche based on the investor, or super niche based on the strategy of, we buy Sears and, big box retailers that are going out of business by the day. We only in places zoned as C2, whatever, and we convert them into storage facilities in 12 months or less, and we lease them up in another 12 months or less. And that is our really unique strategy versus, we're value add self-storage, et cetera. So it could be the strategy, it could be geography, it could be the investor you focus on, or it could be something else, which is core to the reason why you launched your business in the first place. But it is really important that you're unique in some very specific, tangible way. And ideally, you've got 2 or 3 really high conviction reasons why somebody should invest. Like with our Airbnb fund, there's not many Airbnb funds on planet Earth. That's one thing that helps us. The other thing is that we have a 22-person team in our organization, and most investment groups are pretty small teams. And the other thing is that you can visit the assets. It's a little bit more fun to visit our assets than a workforce housing property. And then the final thing is that we don't charge $1 of asset management fees, and we don't benefit or profit in any way until our investors double their money. And most people aren't offering others investments where they only make money after you've already gotten all your money back plus doubled your money. So we use those components to sell people on investing in the Airbnb fund that we run.
Very cool. And do a lot of these family offices prefer to work with groups that are niched more so than groups that are more broad? So
yeah, I think that what you have to think about is that, like, Brian Tracy was one of my early mentors, and he often said that you can take a better picture with a disposable camera than you can with someone on ESPN with a $100,000 camera if that $100,000 camera is not allowed to focus. And who you're really competing with are people that have 100 million, 300 million, 500 million AUM, who are just grabbing all the capital from investors all day long, while most other people are struggling to raise 2 million, 5 million, 10 million, 20 million. Once you get to raising more than 10, 20 million of equity per year, you start to really take off, and then the sky's the limit. Once you have 100 million of AUM, you have established credibility. Once you have 300 million, then you're off to the races, and you'll be at $1 billion in AUM before you know it, and it'll seem like almost magical how fast it grows. And so you're not really competing against them head to head. You don't want to, or you'll lose. You have to be better at developing a certain type of investor relationship and hopefully have a more unique strategy. So that big firm might have one division that does focus on taking Sears shopping centers and turning them into self-storage, or whatever the niche is that you're doing. But it's just one thing of 20 things they're doing. You may be able to put your branding and positioning out there so that you are the best known for doing that, or you are out there the most banging the drum on podcasts and at conferences about that exact niche strategy. And you can focus more than your big guerrilla competitors could ever focus, because they have to pay the bills and have their 200 employees of overhead fed. So that ability to laser focus is super important, so that you're competing against them in a different way. And you're doing something different in a way that the investors really care about.
Right, that's cool. Have you ever had a deal with a family office, big check writer, that the deal didn't go as well as planned or went badly?
Yeah, we've had a few. We've had one where we had a $4 million allocation to a JV partner. Everything was fine. We were just forming the legal documents to put the money in, and then the CFO said something dumb, and the investor changed their mind and said, "Okay, deal's canceled. I don't want to work with you guys." And then the deal was over. We had another where we took somebody by connecting them with a billionaire that they met through one of our conferences, from 30 million of assets under management to 140 million in just 14 months. And once they got to 140 million, they got a slightly better term sheet from somebody else. And even though our contract had them working with us for many years to come to take them to 300 or 500 million, they got slightly better terms from someone else and didn't appreciate that we took them from very low to a decent moderate size. and they kind of retraded us, and they walked away from the agreement, which was disappointing, but we weren't going to hold them in handcuffs and say, no, you have to do this with us. So we just let them go on their way, and we have other positive things getting done, but they could have potentially sued them over that if they wanted to, but they didn't think it was worth legally going after them. But those are examples of two deals, which have gone bad.
Well, yeah. So I guess what I'm looking for is are these people a lot more rational? So they'll look at the deals like, yeah, it's bad deal. We'll still continue to do business with you because we like your communication, or whatever that case is. Where are they harder on you when deals go south?
It depends on the situation. If you've done things the right way all along the way, and you've started out by building trust, and then something bad happens, and afterwards you've done the right thing, then I think that they'll be slightly more understanding than a stressed out small investor that's just mad they lost their money and now their life is ruined. Typically, the big investors are investing amounts that it's not going to change their lifestyle if they lost 100% of that $4 million investment. But losing 100% of an investment is also pretty rare. Usually a bad result is just breaking even or losing a little bit of money. And for really big families, they take a lot of responsibility on themselves. If it's a billionaire doing an investment, they're doing a lot of research and analysis and underwriting the deal, et cetera, and they take full responsibility for their actions. Sometimes the smaller the investor, the more that they just expect, oh, I thought someone else did the due diligence. Like, I'm too busy. I don't know what I'm doing. So sometimes they're the ones that may get more upset or more hurt by an investment going poorly or be less forgiving. But if it's your first experience with someone and you pitch them a deal and the deal is just, not well put together and there's just horrible assumptions in there, you lose a lot of credibility very quickly. Like they don't really have patience for people that are not being honest or not being forthright with information or not being transparent or fair. And a lot of companies are losing money, or they just do a little bit of revenue and they say, oh yeah, but once you put your money in, we're going to go up and we're going to do 40 million in revenue in just 2 years. And right now they're doing like 300K in revenue. And that's why they say they're worth $100 million or some ridiculous amount. They get pitched stuff like that all the time. And so you have to really watch your assumptions. Otherwise you'll just lose credibility with the family office and they'll figure that you're not really playing at their level if you're trying to sell those types of deals to investors.
That's awesome. I just out of curiosity, I'd like to know, how much have you personally raised from family offices, and how much have you helped others, within your network raise from family offices?
Sure. I mean, I don't know how many deals get done per year. Like at our last event in New York, we had 1,000 people there, and we had 75 one-on-one 5-minute speed meetings going on between my clients in a side room. And then in the room, we had 50 speakers on stage. So tons of connections go on at every single event. And there's no responsibility they have to report any of that to us. And we've done 185 workshops and big events. So I don't know how much in deals have gotten done over the years. I know that what we have touched is about $500 million worth of deals. And so far this year, we've gotten $81 million worth of transactions done. And we've got a couple big ones pending that'll close either this year or next year. So we hope we hit 100 million before the end of the year. We're pretty confident we'll get that done. And one thing though to be clear on is that some of our role is helping investors place capital. So we don't even look at it like when I talk about representing $1 billion plus balance sheet partners, to the person who is getting the capital, it looks like raising capital, but to the person with all the money and the big balance sheet, they're trying to place capital. So we're really a community where, maybe we'll have some big keynote speaker that we finally pay a speaker fee to, but so far out of 185 live events, we've never paid a speaker fee of $3,000 or $10,000 or $50,000. Like when Grant Cardone has spoken at our events 3 times, he did so because he wanted access to our network. And when billionaire Jeff Hoffman spoke, who founded the airport kiosk device and became a billionaire because of that, or Larry Namer, who sold eChannel for $3 billion, was on stage last month at our event, we didn't pay them to speak. They were there because it's a community. So if an investor's on stage, they're there to get a deal done. They're not there because they're a famous Army general or they're a famous sports star from 20 years ago and we paid them $50,000 to be there, So I think that's important to have a sense of community.
That's really cool. Yeah. I mean, I would assume, the deal flow that goes through, your groups and your network, your community, probably in the billions of dollars a year, huh?
Right,
Yeah.
right. Yeah. I would guess that perhaps $1 billion a year. I don't know. You see some people that just, we're always careful not to make overly crazy big claims, because I feel like there's no room to over deliver if you're just like saying, oh yeah, we've got $1 trillion of capital in the room. Like it like sounds like hokey on some level and you kind of lose credibility. So I don't know. We try to be a little bit anti that, even though maybe we don't brag enough or do the whole Wolf of Wall Street chest beating.
Right. Very cool. What are some of your favorite tools that you use in this business? Sure.
We use HubSpot quite a bit. We use Hubstaff to manage our employees virtually. So it takes random screenshots of their screens while they're working, and we can see how many hours they worked and what they were working on. That kind of keeps people honest and putting in an honest day's work while being virtual. We use Slack, and then every day when my team checks in, they do a start of day report on what 5 to 7 tangible things are going to get done today. And at the end of day, they do an end of day report on what they got done. And then that way they're self-reporting. If I don't have time to even read it some days until the end of the day, maybe it's okay, because it makes them every day say, what am I going to accomplish today? And then measure whether they accomplished it. And otherwise you might ask people, oh, what are you working on? Oh, I'm working on the pitch deck. Oh yeah, today I made progress on the pitch deck. It's like, well, what'd you really do all day, right? Did they do nothing? Did they get a lot done? So a lot of people use Slack, but not a lot of people use that part of using Slack. And then also we use a ton of audio messages. I'm really quite anti phone call unless it's like a top 100 client across my whole business or JV partner. Then I'm all about doing audio messages. And then that way I might be between meetings and I've got 10 minutes driving to my next meeting, and I can listen to 2 audio messages, send out 3 or 4 more. And when I have time, reply in audio, what could take this long to write out over email. And then that just saves a ton of time. And then I also am very thorough on follow-up. And I do write long emails that can replace hour-long phone calls because I type quickly. So I type out a long email, and then the family, we're helping someone create a family office. The son who engaged me can show that long email with all the ways we can add value and all the next steps to the father, to his mother, to his sister. They can print it out if they want to. We can refer back to it on the next phone call as an agenda. And I don't get on the phone with people unless I have an agenda for it and I've reviewed their materials, because I don't want to get on there and spend all of our time saying, listening to where they went to college and what their strategy is. And I want to like get on the phone and be like, here's the 3 ways I can help you. Why don't we spend my energy like doing these 3 things and introducing you to this person versus you reading your pitch deck to me, and just killing me slowly, right? So people who are like super busy need to have like an agenda, a really focused meeting. And my best phone calls are sometimes like 6 to 8 minutes long, because people know exactly why you're talking. You get to the point, and then you get off and you get on with your day, right? Having like, oh, let's fill up the whole 30 minutes. Let's fill up the whole hour is something that just becomes more and more painful the busier you get.
That's awesome. All right. Actually, I do have a follow-up. So the with the market the way it is now, right? With the interest rate happening, and are there any in the family office space? Are there any fear? How are the these family offices are looking at their investments? Are they holding off? Are they being more aggressive? What are you seeing?
In general, investors are being more careful because they know values are going to be going down in Q4, even Q1, Q2. The general consensus is that things will get worse until March, April, May, June, perhaps somewhere in that time range is kind of the general opinion of what people are stating. In general, people cross their fingers and hope interest rates go back down in 2024, 25, but everyone's just guessing. Who knows if Biden's going to try to print $1 trillion, get reelected, or if stuff with Russia escalates or other things happen, right? Super unpredictable. So it's important from their perspective to make sure they invest in someone with a really strong value add proposition. So values of properties could go down 20%, but so much value is added to the property that you still got a good return. And then if you can hold it till the market corrects in a couple of years, you got a really good return and you're in good shape. And so people are more conservative on levels of debt right now and looking at worst case scenarios. And they're more sensitive to risks, which could blow up a deal. So some investors are doing a little bit more hard money lending. So they get a higher percentage return now, and then they're secured by the asset. And some investors who are experimenting with a few niches said, well, right now in such a volatile environment, until we feel like things have hit rock bottom, let's stick to the two industries where we made our money and just double down there because we can play defense and offense there better than experimenting in new industries. So those are some of the things we're seeing, but the worse the market gets, the better deals we're getting. We're looking at buying a large piece of acreage right now for our Airbnb fund, and the price was reduced by 33%.
Wow.
We're assigning docs on an asset we're closing today in the Grand Canyon on 2 acres that was going for 1.5 million, and we got it for $1 million flat, plus the furnishings. So there's things out there that are being discounted at 20% up to 33%, as all of you know. And so I think families are excited to take advantage of that. Even if prices go lower, they know they didn't buy at the top, and they know at some point it's going to go above what they just bought it at because it's 20% discounted from what was the top.
That's awesome. With you being around so much money, I mean, I grew up dirt poor when I first came here to America. My brother was 19, I was 12, 2 boys on the street. And, with your kids growing up in a family where, they're used to surrounded with, very wealthy families. What are you teaching your kids that perhaps other parents are not teaching this?
Sure. Yeah. One thing is we have our family values on the kitchen wall above our table. So the kids, when they get in trouble, it's because they broke one of the family values. We make them read the values at dinner time, or we reward them for acting in line with the family values. Everybody has values for their company, and they're usually up on the wall. And it'd be really lame and boring for me to say, oh yeah, make sure your company has, core values, because like everyone learns that, in business school or something. So it's not anything new, but almost no families have their family values posted at home. They're valuable for the exact same reasons. So that's one thing. The other one is that oftentimes, for whatever reason, my kids have gotten in the habit of saying, oh, do you make a lot of money if you work here at Disneyland, or if you work at McDonald's, or if you work at this pizza place? And they've learned the answer is almost always no, unless you own it. And if you're the owner of the pizza place, you might make good money. We also have a fun ticket system. We have these little yellow tickets with smiley faces on them, and they get rewarded with fun tickets when they do good things, and they can use those to get prizes off the shelf here at home, like a toy or buying a new, game or something like that. And then we do things like lemonade stands, and we'll teach them, like, we're not doing a lemonade stand in front of our house because we live in this gated community on the side of a mountain where it's just like almost like senior livingville, and nobody leaves their house. We go to like downtown Scottsdale, and we'll have like 5 bachelorette parties go by, and a whole shuttle bus of bachelorettes come out and buy lemonades, and people throwing $20 bills at them because they're female entrepreneurs, and they have fun with it. So if they want to buy a little kid electric Tesla car, we say, okay, but you're going to buy it with your own money and you're going to earn it. And we'll set up a lemonade stand, and they'll bring in like $250 in 2 hours. And then they'll go and spend that and get a new Chromebook or get something they want to get. So we teach them, like, you have to earn money. No one's going to give you stuff. And so the last thing I'll say is that when they get older, we'll help them pay for college and a master's degree, and maybe up to $100,000 towards a house down payment, so they're not a renter forever. But otherwise, unless there's a medical emergency, they're only getting more money if they start a business that we approve of, and then we'll lend money to that business at a very cheap rate, and we'll be their cheap SBA loan that they're pre-approved for, only if we think the business idea is legitimate. Otherwise, they're not getting a whole bunch of money just to, party the whole time they're at college, or, buy a condo in Miami Beach or something like that, right? Like, we're not going to give them a bunch of inheritance just because I worked hard. It doesn't mean they deserve a bunch of money.
Right. That's awesome. Wow, I love that. All right, Richard, for the folks listening, they want to reach out to you, connect with you, attend your events. Where would you like to send them?
Sure. If you want to check out our event schedule, the best thing to do is go to familyoffices.com, and you can see our charter membership. If you go to familyoffices.com/join, you can see what's involved with the membership. We've got about 800 investor mandates there. We do a dozen capital raising workshops a year. We have 4 1,000 person investor club summits per year, and we're raising our pricing by about 25 to 33% per year. So when you join, it'd be grandfathered in at what you pay for. Eventually, it'll be more of a high-end membership. That's where we're moving to. But we have about 1,000 members in that platform, and the schedule is always on the homepage of familyoffices.com. But we've made all of our money by doing exactly what you're doing, Tim, because we have similar mentors, and we give away more value than we charge for, obviously, or I wouldn't stay in business, but we give away a ton of value before we charge a thing. So you can get my free book on capital raising at capitalraising.com. You can get my free book on family offices at familyoffices.com. You can stream 400 podcast episodes on the Family Office Club podcast, or watch 300 videos on my YouTube channel. I mean, you could digest a lifetime of content and never pay us a dime, is the honest truth. But if you want to come to the live events, then obviously that involves membership, same with our membership portal. But just like you, Tim, we're all about just trying to be super generous, because I'm not running the same business that you guys are. And maybe a decade from now, I'll be, maybe you'll be my most important client, or vice versa, et cetera. You never know what business may develop over the long term. Like I recognize Kirk getting on here by chance, for example, and he knew me beforehand and got to know Ruben pretty well here. So that we're really long-term focused.
That's awesome. Just really appreciate you so much for your generosity and coming here and sharing with us all of your wisdom.
Sure. Thanks, Tim. Appreciate it.